Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is a very special edition. It's our edition for July 16. It's also episode 300, which is a really big milestone. We started this podcast during the pandemic as a way to connect with our customers. We've now done 300 episodes. I'm Dean Croak here at DAT Freight and Analytics. I'm a market analyst. I'm along with Tim Denoy, Vice President and Senior Analyst at ACT Research. Tim's also the author of the CAS report, which is coming out later this week. Welcome to the show again, Tim. How are you?
Thanks, Dean. Very good. How are you?
Yeah, I'm pretty good. I'm a bit beaten up from being out at the Iowa 80 truck stop last week. It's hot and humid out there in the Midwest, but it was good to catch up with a lot of old and new truckers and also take the pulse of the industry. Got the opportunity to chat to a lot of truckers as they fueled up to get a read on the industry. Also had a chance to look at one of the museum. They've got a fantastic truck museum there. It was also believe it or not, Tim, the 60th anniversary of the Iowa 80 truck stop, dating back to when Bill Moon founded it. He also founded the CAT scale, the certified automatic truck weighing system that we see everywhere. And it was the 26th anniversary of the Walcott Jamboree, or truck show as they call it out there. So lots of big news out there last week. We did a couple of spots on Radio Nemo with Dave Nemo for our marketing team. So it was a big week in trucking. How about you?
Yeah, we had one of my colleagues out in Iowa at the Taylor and Martin auction.
Yeah.
Big auction. It seemed like there was some interest in terms of buying used equipment. Still not a terrible market out there. Still pretty decent industry vibe overall. I mean, the conditions are saying not brutal, but there's still a lot of activity.
Yeah, it's interesting when you drive out along I-80, you go past, the RV capital of the world in Elkhart, Indiana. And I was struck by how many RVs were just parked in fields. And of course, RV sales are a really good barometer for the overall economy. The further you get west, you start to see, lots of auction inventory piled up. And it looks like auction inventories are pretty high. I don't know how you get a read on that. Maybe that comes across in your used truck data.
Used truck inventory is a very tough one to pinpoint. I do know there's a few fields full of unsold trailers at the moment out in the Midwest in certain places as well. And so there's a lot of equipment out there. I think the used tractors are moving pretty well, though. I don't think they're building up nearly as much as we have in past cycles.
Okay.
Because we've come from such a tight place from an inventory perspective over the past several years. We've certainly been adding a lot of new equipment to the industry, though, especially really over the past 2 years. So there is a lot out there, but it's moving well so far.
Tim, for those new to the show, tell us a bit about yourself and ACT Research and what you do out there.
Sure. We love our partnership with DAT. We study the freight markets just like you guys do, and we also cover a pretty broad range of commercial vehicle data. We have really great relationships with the manufacturing side of the industry and the dealers, and a variety of interests. Where we do a lot of work with basically the classes 5 through 8 data, used truck price data, as we've talked about, and a number of data sets like that. And so we try to bring a supply side perspective to the economics research for the industry.
Right, fantastic. Well, we've got lots to talk about. There's lots of news coming out on new truck and trailer orders I want to get to and talk to you about your long-term forecasting. But let's get started with some of the key trends we're watching this week. Spot rates. I think the level of excess capacity in the market was evident last week. Dry van line haul rates dropped about 3 cents a mile on 5% higher volume of loads moved. The change in line haul rates post July 4 is identical to the 8-year average week over week change for week 28, so no real surprise there. Load post volumes are up last week ahead of retail shopping, which took center stage. Back to school shopping is well and truly underway. Amazon Prime Day is, of course, this week. Last week's load post volumes were about 7% higher, almost identical to levels seen at this time of the year during the pandemic in 2020 and 2021. We took a look at produce season this week. Produce season peaked about 14% lower but also very close to the July 4 peak back to 2019. So fairly similar volumes. They were down last week, though, significantly. They dropped 24% last week. That's something we're watching. The average week-over-week change post-July 4 is closer to 14%. Big difference last week. We're going to talk to Tim about truck orders. They're both down. Trailer orders down significantly. I want to dive into what that means with Tim after the market update. Also watching speed limiters. The federal regulators have delayed several rulemakings affecting trucking, including the incredibly controversial rule on truck engine speeds. The truck speed limiter rule has been delayed to May 25. I did 2,500 miles last week in my Peterbilt truck attending the I-80 truck show, and I can assure you speed isn't the problem on our roads. It's anything but speed. So we could, that's a topic for another day, but it's not speed is not the issue when it comes to inexperienced, low tenured drivers who have been set loose on the roads with very little experience. New Jersey, watch this one. Everybody should be contacting their broker and underwriter immediately. New Jersey's increased the minimum liability for commercial vehicles to $1.5 million. This is causing a fair bit of confusion. I'm told by underwriters this is for renewals post 7/1 for New Jersey registered trucks only. It's going to be interesting to see if courts choose to apply this to trucks driving through the state that pay IFTA taxes, something for all of us to watch. But in the meantime, get in contact with your broker to make sure you're not exposed traveling through New Jersey. In this week's market update that'll be published later today, we're talking about the 100 deadly days of summer. These 100 days are typically when there's a spike in teen traffic fatalities. There's about a 20% increase, or about 7 teens are fatally killed per day in the deadly 100 days. We're also diving into the latest traffic data that's published by INRIX. If you've noticed a change in recent years, how the AM peak has shifted to the PM, along with a surge in midday traffic volumes, we're writing about that in this week's blog post that'll be out later this evening. All right, so let's dive into our market update before we bring Tim back. Load to truck ratio, load post volume surged last week. Retail shopping is obviously driving some of that demand. Last week's volumes were about 7% higher than last year. Carrier equipment posts were up also as carriers returned to the network. Load to truck ratio was the second highest since 2016 at 4.71 loads per truck. In the refrigerated load to truck ratio sector, load post volumes were up last week also, and about 11% higher than the week 28 average, going back to 2016, but excluding the pandemic impacted years. Equipment posts were higher last year. Again, carriers came back to the market in full force. Load to truck ratio up 24% week over week to 7.05. In flatbed, load post volumes bounced back also, within about 2% of last year, but still 38% lower than the week 28 average, going back to 2016. Equipment posts are up also, not surprising there. Load to truck ratio up substantially to 14.18 loads per truck last week. Having a look at our year-over-year look at spot rates, the excess of capacity in the market was evident last week as dry van line haul rates dropped 3 cents a mile. Loads moved were 5% higher, though, last week at $1.67 a mile. Remember that, folks, these line haul rates excluding fuel. At $1.67, the national average was identical to last year, as you can see on the chart. The black line is last year, the blue line is this year. It's also identical to the 8-year average week-over-week change for week 28. So a lot of seasonality exhibiting in the market this week. In DAT's top 50 lanes, based on the volume of loads moved, they were down 4 cents a mile to $2.08. That's 41 cents a mile higher than the national average. In the refrigerated sector, following the annual July 4 peak, the national average reefer line haul rate dropped to $2 a mile last week, down 5 cents a mile, also identical to the week 28 week-over-week change going back the last 8 years. So again, tracking what we normally see post-July 4. Produce season's obviously impacting some of that lower demand we're seeing there. We're also seeing produce volumes drop. We're going to watch that pretty closely. That'll have a significant impact, I think, on which way spot rates move in the next few days. Surge in load posts in flatbed, the year-over-year look at rates shows us that the national average flatbed rate was fairly flat at about 205 last week. They're about 5 cents a mile lower than last year, but higher by the same amount compared to 2019. Let's have a quick look at our forecasts. Remember, we'll be changing these forecasts in the next few weeks. we'll be removing the short-term and the blended models and focusing just on the ratecast model with the high and low averages. But for today, the blue line, as you see on the chart there in dry van, that's the rolling 7-day weighted average. Our flagship model ratecast is in green. It's in all of our products. These are for loads moved over 550 miles, excluding fuel. Red is the short-term model. It more heavily weights data we've seen more recently, and the grey and yellow are blends of the two. Rates are flat to slightly up in both van and reefer. Somewhat surprising when you look at that dry van rate. Normally rates drop a little bit more in the 35 days after July 4. Here they're essentially flat going out to the middle of August. And I think that's starting to pick up on some of the correction we've seen in the market with capacity exiting. We're definitely at a point where we're seeing equilibrium of capacity starting to match where demand is in the spot market. Hence ratecast, which is the most accurate of our models, has dry van rates pretty flat out 35 days. In the refrigerated model, similar story. Rates are in fairly strong agreement, although rates are predicted to be up 3 cents a mile in the next 35 days. I think that's a reflection of how tight capacity is going to be with the exodus of capacity that's just continuing to go on in the market. And flatbed, of course, down 9 cents a mile out to 8.17. No surprise there. Rates normally drop in the order of about 30 cents a mile from July 4 to the end of September. Of course, we've got a ways to go before we get into September, but rates are on track to head where they normally go. All right, so that's our short-term forecast. Look for a change in this forecasting methodology in the next couple of weeks. Let's bring Tim back in and talk about the new orders market. Tim, compared to last year, trailer orders were down 46% year over year. New truck orders down 12% year over year. What's that telling us about truckload demand and how large carriers see the road ahead?
Yeah, it's a great question, and that difference in those two percentages tells you a lot of the capital in the industry is sort of more focused on tractors than trailers right now, and there's good reason for that at this point in the cycle. There's a lot of regulations coming up that fleets are preparing for. That's one of the main reasons for the difference between the bigger drop in trailers, but we were frankly relieved with the lower June truck orders because they had really jumped a little surprisingly in May. Turned out that was some order slots being opened up, and it wasn't necessarily, it was a little bit lumpy. And so the June rate, which was only down 12% year over year, was actually a still pretty low rate, which it's not great for the manufacturers, but it is good from a cyclical perspective, that it does suggest that manufacturers are going to have to ramp down a little bit and stop adding so much capacity, which eventually will help the market to tighten.
Right. So how do you see trailers? I mean, there was a time a few years ago where we couldn't find trailers. We were moving, literally fresh air in trailers from market to market to reposition assets to haul freight. Yeah. Of course, that's in the rear vision mirror now. So trailers, is the drop in trailer orders just a function of we've had too many trailers ordered in the last couple of years? We have an excess of capacity sitting idle, or is there something else driving that?
Well, certainly the need for that sort of power-only brokerage model that was so important during the pandemic, that has really changed, and with the overcapacity that we've had in the last couple of years, that's the main change. That's what put it in the rear view, as you said. I agree. I think cyclically you could see it coming back, and that could change again, but that's just not the market these days.
Difference in trailer type. When you say, you talk about trailers generally, is there a difference in dry van, reefer, lift gates, those sorts of things?
There's always individual niches, and the refrigerated market's always one that we specifically look at, especially we worry about these hot summer days. They caused a lot of excess use in those reefer units over the last couple hot summers, and I feel like there's some risk there. But broadly speaking, I think that the trends are pretty general. They're all driven by the industry's finances, frankly, and those have been under pressure for some time. So we're all pretty much in the same direction.
I think it was a couple of years ago, or maybe even last year, at your seminar we had in Columbus, one of the trailer manufacturers was talking about trailer to tractor ratios of 8-1, which kind of caught me by surprise because I work on a normal average of maybe 3 or 4 to 1. Is that sort of a reflection of that ambitious look at trailer pools? But I sense that's changed. Are people, tapering off that expectation of very high trailer to tractor ratios in that 8-to-1 range?
Oh, I think 8-to-1 sounds pretty astronomical. I think with some types of specialized operations, who knows? But I think fleets are under some enormous financial pressure right now, and profit margins in the industry are just not really allowing them to take those numbers up at this point.
Yeah.
And plus the price of trucks is going to go up, considerably in a few years, and so fleets are trying to get ahead of that, and that's kind of why the spending is going towards trucks where it is being spent.
Right. In a prior job, I worked at a trailer telematics firm, and we did some studies on the position history of trailers. We may have talked about this before, but it was essentially a bell curve distribution of loads per week that trailers were involved in, and the average trailer turns per week was 0.98. So call it 1, the trailers, and these were trailers with lift gates, so they weren't inexpensive, and they were running essentially a load per week. But the fleet said if they could get it up to 1.1, it would save about $5 million in CapEx, which of course would be very topical right now. But the challenge was with the data and the trailer pool, and I think this is inherent in most trailer pools. Some trailers did all the work, some did none.
Yeah.
And it really wasn't a function of anything other than the trailers were buried in the back and they never got picked up, but it was always the trailers on the front of the line that got loaded all the time. So it was really a physical constraint when it came to managing trailer pools. I think trailer pool management's a much harder exercise than most people realize. It's not just about the number of trailers, it's about how you use them.
Absolutely. I think a lot of one of the big themes of this year has been how private fleets are trying to use their equipment more effectively, and I think their trailers is one of the biggest challenges there, because a lot of even if we're talking about a distribution model where the head haul is a in-house private fleet move, the backhaul is oftentimes taking empty containers back or something like that, which inhibits the moving into the for-hire market. But I think fleets are getting a little bit better about getting around that, and I think to the extent that there are purchases being made for expansion in the trailer market, it is probably those private fleets these days.
Yeah. Can you talk a little bit more about the private fleet growth and how that's driven, you think, by the 2027 pre-buy?
Mm-hmm. Yeah. If you look at 2023 data, for example, just FMCSA data, it looks like the for-hire market was down considerably. There's a range of data that you can look at, but just from a capacity perspective, call it a mid-single-digit decline in capacity for the for-hire market. And then private fleets grew a couple percent. So that's a pretty significant change for this industry, where the multi-decade trend has been towards outsourcing, and that was certainly exaggerated during the pandemic, and to some extent what we're seeing right now is just sort of a reversion back to the mean. Some of it's just rebuilding supply chain resilience from those years of supply chain pain. But as we look at 2027, we think the costs of a new Class 8 tractor sleeper is going to go up about a double-digit number in terms of operating costs, probably 10 to 12%. And so the industry is, especially those with 8 to 9 year trade cycles or more, which describes private fleets pretty well. Those fleets are purchasing, and they're purchasing in greater numbers than we would expect. We would have expected Class 8 sales to fall based on what's happened in the spot market. Much sooner than, but they've remained pretty strong, and that fits the definition of a pre-buy.
Yeah. Tim, I remember the 0607 DEF filter implementation, and I think we had the highest number of trucks ordered ever in 2006. I think truckers have got some pretty long memories when it comes to the impact of bleeding edge technology. I'm, as someone who owns a pre-emission 6NZ Caterpillar, I can assure you I'm worried about cylinder deactivation technology. And I just don't understand it. But can you talk through what the 2027 emission changes will look like? Because if I understand what you've been writing about, it's mostly on the hardware side. Am I correct?
Well, I think most of the costs are actually warranty and useful life. So those are some common sense extensions in the how long the manufacturers have to warranty the after treatment components is actually a big piece of the cost. But I think you're right. I mean, I don't know that all of the details in terms of the engineering, but cylinder deactivation is one technology that is it seems likely. A lot of it is improving the SCR systems, but it was only about 15 to 20% of the cost that's actually the engine changes. Most of the costs are warranty and useful life. So that some of that value does accrue to the fleets that they get more warranty coverage, and so that offsets it a little bit. But to go back to your point of 2006, we do certainly agree that that's probably the best historical corollary for what we're up against, because that was the costs increase in 2027 looks like it's going to be more. So that is a good historical corollary. But the big but is there's two things that need to be in place. There's a willingness to pre-buy, and there also needs to be the ability. Willingness is clearly there. But if you look at 2009, there was no pre-buy, and SCR systems that came in 2010 added even more than the 2007 cost increase. There was no pre-buy in 2009 because nobody had the money. So that's becoming a bigger and bigger risk too. But we do expect, we do believe there's pre-buying going on now, and we do expect it to potentially ramp up over the next couple of years, with that big caveat of how does the cycle go?
So how do you think a possible change in administration and pushback or derailing completely of some of the EPA changes, is that a factor? You think there's a reality that could happen?
Oh yeah, definitely. I think that's a big consideration. It's called the Chevron ruling recently is probably going to have a very significant impact on truck emissions regulations. The interesting thing about the rules I've been talking about is that they were actually first enacted under the first Trump administration. So I think that reduces the risk of the 2027 rules being initially on the crosshairs, especially when there's a much bigger set of rules called GHG3 that is really going to force, or not force, but it's perceived as going to force a lot of zero emission vehicle adoption. To get there, and that's going to be a much bigger deal for really 2028 through into the 2030s, and I think that's the one that I think is more likely to be attacked.
Got it. I want to talk a little bit about macroeconomics before we wrap up the show. Can you talk a little bit about cancellations and vocational trucks? What you're seeing in the mid-sized truck range, as opposed to Class 8s?
The vocational and medium duty are a very interesting piece of the heavy duty truck market, the commercial vehicle market, because over the past few years they've been sort of deprioritized, if you will, given the strength of the Class 8 tractor sleeper market, and now they're sort of there's still some pent up demand in vocational markets, believe it or not, and some of it is on the bodybuilder side, and in medium duties we see it. Our data comes from the manufacturers before it gets to the bodybuilder, and so we see a lot of inventory building up that hasn't been sort of finished quite yet, and so there's a bit of a supply chain issue there, but that's eventually going to work itself out. But it's generally keeping the medium duty market tight. It's keeping medium duty used values higher than we would have expected at this point.
When you say bodybuilders, you're talking about the straight truck box, the dump truck body. Is that what you mean?
Yep.
Okay. All right.
So yeah, a lot of the data we track comes as just cab and chassis from the manufacturer. So
got it. Any split in data in the class, say 7 and 8 category for day cab, sleeper cab? Do you have any insights there?
Yes, the day cab market is really where the orders have been this year, and sleepers at this point in the cycle tend to underperform. So that's happening as you would expect. Right. Okay. It also fits with this private fleet theme, because private fleets tend to operate a lot more day cabs. And the broader sort of long-term theme within freight is there's this long-term regionalization of freight where loads have gone from 1,000 miles on average to 400, and that's getting closer to the wheelhouse of those Daycabs in general.
Mm.
So,
Right.
so I think the long-term trend should be a little bit more towards Daycabs, but certainly it's still very cyclical, and sleepers tend to dominate the up part of the cycle.
Right. Okay, macroeconomics. You're the only expert here that can talk fluently to things like interest rates,
Sure.
inflation, all those sorts of things. What's your take on where the economy sits right now and how it'll look for the rest of the year?
Sure. Our economists think we're in a slowing kind of phase. We had a pretty robust sort of growth spurt late last year, and we're slowing from that, but we still think we're on track for this soft landing, so to speak.
Mm-hmm.
Inflation data recently have been really encouragingly good. Oil prices have remained very steady, which is helpful, and that makes the Fed's job a bit easier. We do think I'm not exactly sure if we have a view on how many rate cuts there are this year, but we think there's a multi-year cycle of rate reductions, which is good, and that should be eventually good for the housing market. There's certainly still some after effects to play through from all the monetary tightening of the past couple of years, but so we think we're in a bit of a slow place for a while. The consumer's under a fair amount of strain. We're not really saving very much. We did just see a pretty decent acceleration in real income growth in just the latest month, which is good. But some of that's just because fuel prices went down. But those are certainly positives from a macro perspective. Certainly the election, as you mentioned earlier, is a significant one we're watching. But who knows if that's going to have a major impact on economic trends.
Do you get a sense from your data that in an election year like this, people just sort of put everything on pause? It's kind of a wait and see attitude.
It's possible. That is definitely a possibility. I think this year it's a particular risk for when we talk about truck manufacturing because there's a lot of uncertainty. Now those orders could flow back in after the election if there's uncertainty, and so the order timing can definitely be affected for sure. But does that really have a huge impact at the end of the day? I'm not sure.
Yeah. Tim, talk about supply chain shortages on the OEM side. Is that still persistent, or is that largely gone away?
Well, there was one big fire at a mirror plant, I believe down in Mexico, just a couple months ago, back in April. And we think there's something like 10 or 11,000 we call red tagged tractors built but unfinished that haven't made it out there yet because mirrors are pretty important. And
not to some drivers.
They are dealing with a little bit of an issue right now. I think that supplier was able to get back up and running at a different location pretty quickly.
Yeah, there's a lot of drivers out there that actually don't use their mirrors, believe it or not. They're part of that category that speeding trucks aren't the problem. It's no good sitting in the middle lane at 62 if you're not going to use your mirrors.
For my 2 cents, just from a macro perspective, I hear you and I understand your view on speed limiters, but if you want rates to go up, well, I'm not sure of any better way to tighten capacity than speed limiters.
Yeah, so I get that. I'm on the safety side. I worry about risk and accidents. I've been to too many funerals of drivers that died 100% compliant to hours of service but sound asleep at the wheel. So I always fall on the side of safety because that to me is the softer human side of the business that's always hard to manage. But anyway, that maybe is a discussion for another day. Maybe we can talk about that when we get together at your seminar. Tell us a bit more about that before we wrap up the show.
We're looking forward to having you out to Columbus in August. And yeah, we have a great list of presenters from the industry. It's going to be a really good meeting. You have people from places like Penske, DAT, JB Hunt, not to drop too many names, but yeah, we're very excited. And And yeah, we have this seminar twice a year. It's really sort of our big meeting where we talk about the outlook for commercial vehicle and freight markets.
Yeah, it's a great event. Looking forward to it. All right. Lastly, a couple of shout outs. We've got the Freightbind podcast that's out. Gonzalo Cordova for Home Depot's on the latest version talking about AI. Don't forget DATCon. You can use code update100 to register for DATCon Kansas City, October 22. You can register at dat.com/DATCon. As we mentioned last week, Brake Safety Week is on August 25. Next week's show, we've got Lee Klaskow from Bloomberg. And Tim, just lastly, before we wrap up, how can people contact you and the folks at Act Research if they need to get in touch with you?
You can find our website. Actually, we have a joint website with DAT that recently was put up there. We should probably have throw that link on the YouTube video after this. But actresearch.net, and you can always find us at various conferences.
Yeah. All right. Well, thanks for being on the show. Looking forward to catching up with you in Columbus, Tim. With that, our episode 300 is in the books. Thanks, everybody, for watching. Be safe. Be nice to everyone. We'll see you again next week at 10 a.m. Eastern, 7 a.m. Pacific.